Okay, let's unpack this. Forget complex formulas for just a moment. Imagine the biggest secret to, well, successful investing isn't really about crunching numbers. It's more about understanding something far more human. Why we make the financial choices we do. Today we're going to delve into the wisdom of a fund manager, someone with 25 years in the market, managing, $7 billion. And he argues exactly that.
Yeah, and it's fascinating, isn't it, how often these really seasoned professionals come back to this fundamental idea. I mean, the analytical tools are essential, obviously, but it's the grasp of market psychology, the collective emotions, the individual biases that drive investor behavior that can truly make or break your returns.
Right, and that's kind of our mission today. We've distilled the key insights from a recent conversation with this veteran investor, specifically for you if you're looking to gain a solid understanding of investing without getting lost in all the jargon.
Exactly. Think of this as your cheat sheet. We've looked at a pretty wide-ranging discussion, everything from big picture market trends to practical strategies for, say, how you might allocate your investments. And crucially, we're highlighting how our own human tendencies play a starring role in all of this.
So what's the takeaway for you, the listener? Investing can feel like navigating a minefield of information sometimes. Our goal here is to hand you the most valuable nuggets, clear, actionable insights that really shed light on what matters without, overwhelming you.
Which brings us to a really crucial point. How often do we actually stop and think about our own psychology when we're making investment decisions? It's so easy to get swept up in the charts, the data.
Oh, absolutely.
But those gut feelings, that FOMO, the fear of missing out on a booming stock, or that sudden urge to just sell everything when things dip, these emotional responses can often, sabotage even the best laid plans.
Totally. This fund manager was pretty emphatic about it. Understanding psychology trumps mathematical prowess for long-term success. Just think about that constant push and pull, right? Fear and greed as the market moves up and down.
And our inherent human tendency. We either shy away from perfectly reasonable risk, or maybe we take on way too much risk without really getting the downsides. Finding that sweet spot, that kind of balanced approach, it really needs a good dose of self-awareness, knowing your own risk tolerance, your psychological triggers.
Yeah, and here's where it gets really tricky. He pointed out just how difficult it is to act contrary to what everyone else is doing. It takes real conviction, doesn't it, to be buying when everyone else is panicking and selling.
Definitely.
And just as hard, maybe, to hold back when the market feels like it can only go up and up.
That's the power of herd behavior, right? There's a certain comfort, a safety in numbers, following the crowd. But if you look back historically, some of the biggest investment gains were made by people who dared to go against that grain. And conversely, market bubbles and those awful crashes often come from that widespread, sort of unquestioning optimism.
So on that note, he gave some pretty straightforward advice.
When the market seems like it's on this unstoppable upward climb, that's precisely the time to, be cautious, maybe trim some profits instead of getting totally swept away in the excitement.
Good advice. Now, let's maybe pivot slightly. The discussion also had this really positive outlook on the Indian stock market. What jumped out at you there?
For me, it was the sheer scale of the opportunity, this idea of India transitioning into a middle-income nation. That's a massive economic shift, right? With huge long-term implications for growth.
Precisely. And when you factor in the projected growth rippling, both the consumer base and the labor force in India over the next few decades, it paints a very, very compelling picture for sustained economic expansion. These demographic shifts are, they're powerful underlying drivers.
Plus, the investment landscape itself is changing, maturing. We're seeing more Indians participating directly in the market.
Yeah, more domestic investors. And a growing demand for different kinds of investment products, this whole financialization of the economy, that can add more fuel to market growth, too.
Okay, let's dig into some of the numbers he shared, the historical performance figures, because they give really valuable context for thinking about future returns.
Right. So over the last, 33 years, India's nominal GDP grew at an average of 12.5% a year. And that breaks down into roughly 6.5% real economic growth and about 6% inflation. It gives you a sense of the underlying economic energy.
And importantly, the earnings growth of the main Indian stock indices, the Sensex and the Nifty, they've pretty closely tracked that economic growth, averaging around 12-13% annually over the last 30 years. That link between the economy and corporate earnings is super important.
So you combine that, say, 12% annual price appreciation on the indices, add in the dividend yield, maybe 1.52%, you end up with an average total return of approximately 14% per year long term.
And this historical data is really crucial for setting realistic expectations. The fund manager specifically cautioned against expecting returns way higher than this long-term average, around 15%. Periods of crazy high growth, they're often followed by corrections, bringing returns back towards that historical norm.
Which leads nicely into a very practical strategy he illustrated. Let's say you invest 10 lakh, and somehow it doubles to euro lakh in just 3 years. That's a huge return, right? 25% compounded annually.
Yeah, fantastic return.
Yeah.
So in that kind of scenario, with such rapid gains, his advice was pretty prudent. Think about taking some of those profits off the table. Reallocate them into something more stable, like fixed income.
Right.
This way you lock in some gains, and you've got capital ready to deploy when the market inevitably has a downturn. It's about being proactive, having a plan.
Exactly, a plan for the ups and the downs. And speaking of market corrections, he shared his own experience during the COVID crash. It's always interesting to hear how seasoned investors actually handle those periods of, well, massive uncertainty.
Absolutely. You mentioned writing a blog post right in the middle of it, basically reminding investors about history, how markets tend to recover after big shocks, and the underlying resilience of, well, human endeavor.
Perspective.
It really highlights the importance of keeping that long-term view and not letting short-term panic dictate what you do with your investments.
He also made a really interesting point about how we frame these situations mentally. How we visualize a market downturn impacts how we react. If you see it as a total catastrophe, you're probably going to panic sell.
Right. But a more rational perspective can help you stay calm, maybe even spot opportunities. And I liked his analogy, stock prices being like a spring. The idea is when prices fall really hard, there's this inherent tendency to bounce back because of the underlying earnings of good companies and the fact that, fundamentally sound businesses, their stock prices can't realistically go to zero. There's a kind of natural floor there.
Interesting analogy. Now let's step back a bit further. Lessons from the 2008 global financial crisis. How did that shape his thinking?
Well, he definitely emphasized how interconnected global markets are, particularly the huge influence of the U.S. market. What happens in the U.S. financial system can and does ripple out everywhere.
But there was a key distinction he made too, right?
Yes, a vital one. Over the long term, the performance of any individual market, like India's, is primarily driven by its own domestic economic fundamentals. So, while global events cause short-term volatility, a country's own economic growth is what really matters for long-haul stock market returns.
He also observed something about how the Indian market reacts to U.S. sell-offs.
Yeah, that initially, India often reacts negatively when the U.S. market drops, partly because foreign investors might pull money out of emerging markets during uncertain times.
Okay.
But, he noted, this can actually create really attractive buying opportunities for domestic investors who have that longer-term view and understand India's underlying strengths.
So, short-term pain, maybe long-term gain for the patient investor. He did mention, though, that in the near term, say the next 3 to 6 months, the U.S. market will likely continue to have some sway over Indian markets, even if India's own economy is doing better.
It's a reminder, isn't it? Long-term fundamentals are key, but you can't ignore short-term sentiment and global links. Okay, let's switch gears. How does this fund manager actually structure his own portfolio? Sounds like it's fairly balanced.
Exactly. He described it as roughly 50-50, half in equities, so stocks, and half in real estate, but with a big emphasis on commercial real estate, not just houses, which might be different from how many individuals think about property.
Yeah, and his reasoning for focusing on commercial real estate, calling it a factor of production, is quite insightful. He sees it as directly tied to the economy's health. If businesses are growing, expanding.
They need space.
They need more office space, retail spots, industrial facilities. So that drives demand for commercial property. It's a tangible asset, very linked to economic activity, kind of like equities in a way.
And his strategy within commercial real estate, it's mainly about generating steady rental income, right? The yield, enough to cover the property expenses.
Right, creating that consistent cash flow stream from the real estate holdings.
He also mentioned using bank loans leverage to help buy these properties.
Which is common. Borrowing part of the purchase price can potentially boost your returns if things go well. But you have to remember, leverage is a double-edged sword. It also magnifies potential losses if the property value drops, or you can't find tenants.
And he did mention those risks, didn't he? Like vacancies, needing enough working capital to manage the property and cover costs. If it's empty for a while, it's not passive.
No, it requires active management. Okay, turning back to the equity side of his portfolio, that's also split, roughly 50-50 again.
Yeah, between publicly traded stocks, the ones you can buy on the exchange, and private equity investments.
Right.
The overall goal for both is long-term capital growth.
And the private equity part involves investing in venture capital funds, which he noted usually need a pretty hefty minimum investment, like 1 crore.
Right, not for everyone.
But the potential returns there can be quite significant. He mentioned maybe 3 to 4 times your initial investment over, say, a 7 to 8 year period. It shows the potential, but also the risk and illiquidity in private markets.
And overall, his total portfolio across everything has achieved, around 18-20% compound annual growth over the last 5-10 years?
Yeah, which is very strong. And he attributed most of that growth primarily to the equity component, both the public and the private parts.
Now, thinking about strategic real estate investing, beyond just the core commercial stuff, he had an interesting principle there, looking for sectors that need low initial capital but could see big consolidation and value growth when the market cycle turns.
Right, it's about identifying those sort of overlooked, maybe undervalued segments of the market.
Timing and location seem absolutely critical for that strategy.
Definitely. Finding neglected sectors where there hasn't been much recent investment, that's where you might find those outsized returns when demand eventually comes back and the sector consolidates.
Okay, let's hit our rapid-fire insights. He had a book recommendation that sounded quite interesting.
Yes, Investing, The Last Liberal Art by Roger Hackstrom. And the core idea ties back perfectly to where we started. It argues that really understanding investing requires insights from lots of different fields, not just finance, history, psychology, even science.
The multidisciplinary approach. Back to human behavior again.
Exactly. And on that note, he also tackled that common myth that you need to be a math wizard to build wealth in the market.
Yeah, she pushed back on that.
He emphasized that the fundamental ideas are actually pretty straightforward. Things like the power of compounding your money, making more money, and understanding present value, the time value of money. It's about deeply getting those basics, not getting lost in super complex formulas.
Good point. And his take on the classic rent versus buy debate, it was quite nuanced.
It was. He acknowledged that buying a home early on can offer significant leverage, mainly because you can get a mortgage.
Right, controlling a big asset with less cash up front.
And he pointed out, a mortgage is often the only chance most people get to borrow a large sum at an interest rate that might even be lower than potential investment returns elsewhere.
And if you choose the location and timing well, the property appreciation can be a big wealth builder.
True. However, he also stressed the drawbacks, the big one being the long-term financial commitment of EMIs.
Yeah, those monthly payments.
And the fact that owning a home makes you less flexible.
Oh.
It ties you down geographically, makes it harder to move for a job or other reasons, unlike renting.
And he really brought it into today's context, didn't he? Saying the situation now is tougher for younger people, house prices are much higher, starting salaries maybe haven't kept pace, so that traditional path to ownership is just harder.
Definitely. The key takeaway there is that rent versus buy, there's no single right answer. It's so dependent on your individual situation, where you live, your income, your job stability, your tolerance for risk, for having your money tied up in property.
Right, it's personal. But he did end with a bit of encouragement for those thinking about buying, didn't he?
Yeah, basically saying, start thinking about it seriously, start planning your finances, and take that first step when you feel ready, even if it feels like a huge commitment. Just begin the process.
Okay, so let's try and synthesize the main insights from this deep dive. First, remember the huge role psychology plays in your investment results. Maybe the biggest role.
Right. Second, the Indian market looks to have a compelling long-term growth story ahead.
Third, think long-term. Be strategic about how you allocate your assets, maybe even considering things like commercial real estate.
And finally, don't be intimidated by complexity. The core principles of building wealth, like compounding, are actually quite accessible.
Absolutely. So on that note, here's a final thought for you to chew on. Given this interplay, this dance between big market forces and our own often hidden psychological biases, what's one small, concrete step you can take, maybe even today, to understand your own investment tendencies a little better and use that understanding to make more informed decisions for your financial future?